Okay, so you know how everyone keeps talking about like central bank just pumping money into economies?
Right, tons of liquidity, yeah.
Yeah, exactly. And then but the economy doesn't seem to be growing that much.
Right.
It just feels kind of underwhelming, doesn't it? It feels like something is off. Like, where's all this money going and why isn't there this like huge economic boom?
Yeah, well, that feeling you're having, that disconnect between all that monetary policy and the real world results, that's exactly what we're looking at today.
Okay.
With Richard Koo's ideas in his book, The Other Half of Macroeconomics and the Fate of Globalization.
The other half. Like there's something missing in how we usually think about economics.
Exactly. Koo really argues that while typical economic thinking makes sense, it's got some like blind spots,
Okay.
especially when we're trying to figure out like all these economic problems we've had the past couple of decades. And he basically says his framework is like essential to make sense of it all, the current economic landscape.
Gotcha. So what's this big overlooked idea? What's this other half that we're missing?
It's his theory of balance sheet recession, or BSR.
Okay.
Koo says this is the crucial other half of macroeconomics, and we need to get it, especially after these big asset bubbles and all this slow growth.
Balance sheet recession, BSR. Okay, so we're diving deep into this BSR theory today and seeing how it helps us understand the global economy, right?
Exactly. And we're using this summary of his book to get there.
Great. A good summary is always helpful. So where does Koo start with his critique of the usual economic theories? Why does he think we need to rethink some of these models?
Well, he says, look at all the economic crisis we've had lately.
Yeah.
The dot-com bust, the 2008 financial crisis, and then these like weak recoveries afterward. All of that really challenges the basic assumptions of some of our economic models because they usually assume that, lenders and borrowers are always acting in a way that's like optimal.
Like always looking for the best deals, making the most profit-seizing opportunities.
Yeah, exactly. But Koo's argument is that it doesn't always work like that, particularly after a big shock to the system, like when an asset bubble pops.
Right.
So he's got these 4 scenarios based on how lenders and borrowers interact.
4. Okay, lay them out for us.
So first you have what he called the equally matched scenario.
Okay.
It's basically your textbook Econ 101. You got enough people and businesses wanting to borrow money and enough lenders supplying it.
Right. Classic supply and demand.
Yeah, interest rates do their thing, pretty predictable.
Like the models we all learned, yeah.
Exactly. But then it gets more interesting. Scenario 2 is when there's plenty of borrowers, but not enough lenders.
Okay, when does that happen?
Think financial crisis, a credit crunch, banks get scared to lend because of bad loans or worries about their own stability. And even if the central bank is trying to keep interest rates low, the actual rates on loans are higher because of this limited supply.
Makes sense. A real credit blockage there. So what about the third scenario?
This is the key one for Koo's argument.
Okay.
Enough lenders, but not enough borrowers. And this is the heart of that balance sheet recession idea. It's also got ties to what some economists call secular stagnation, which is basically long-term slow growth.
Right.
So even with super low interest rates, businesses and people just aren't borrowing much. It's not that there's not enough money available. It's that they don't see great opportunities to invest or, and this is Koo's main point, they're focused on fixing their own balance sheets.
They're digging themselves out of debt, cleaning up their finances instead of taking on more debt, even if it's cheap.
Exactly. And then scenario 4 is the worst case. Nobody wants to lend and nobody wants to borrow.
Ooh, sounds rough.
Yeah, this usually happens right after a massive asset price crash. Like everyone's dealing with balance sheet issues. Banks are drowning in bad loans.
Right.
And even though interest rates might be low, only the most trustworthy borrowers can even get a loan, if anyone can.
Gotcha. So Koo's saying the real problems come when there aren't enough borrowers, like scenarios 3 and 4.
Yep.
And he thinks most developed economies are in that boat right now.
Yeah, that's his big point. He thinks the sluggish growth in many rich countries is because of these balance sheet recessions where everyone's paying down debt instead of investing. And there just aren't enough enticing new investments to get them borrowing again. He points to Japan, the UK, much of Europe. They're all stuck in this after their asset bubbles popped around the 2008 crisis.
So in this kind of environment, just lowering interest rates doesn't really work because the problem isn't the cost of borrowing. It's that people don't want to borrow in the first place.
Right. It's like trying to help someone who's drowning in debt by offering them another loan with a slightly lower interest rate. It's not going to change their behavior.
Makes sense. So what does Koo say about income distribution? How does that play into all of this?
Well, he looks at it through these 3 stages of long-run capitalist development he's come up with.
3 stages. Okay.
First stage is urbanization, people moving from rural areas to cities for work.
Right.
More workers means wages stay low, but business owners are making more profit because they have all this cheap labor.
And you need to build all this new infrastructure for all these people in the cities, right?
Exactly. Housing, transportation, utilities, tons of investment opportunities there. But the result is rising income inequality.
Yeah, it makes sense. Lots of workers competing for jobs, wages stay low, but the companies building all this stuff are making bank. So what's stage two then?
He calls it equilibrium, so urbanization slows down. There's not this huge surplus of labor anymore.
Okay.
So the power dynamic shifts, wages start going up, workers have more bargaining power, inequality decreases.
So like the golden age of capitalism in the US and Europe after World War II?
Exactly. Strong unions, rising wages, a growing middle class. That's stage two for Koo.
Okay, so what about stage three?
Stage three is the pursuit stage. This is when you have these newly industrializing, rapidly developing nations, what he calls the pursuit economies. They start catching up to the richer, more developed countries.
So like post-war Japan.
Exactly. And this catch-up creates competition for the leading economies. Returns on investment go down, wages, especially for lower-skilled workers, stagnate or even fall, inequality rises again, and manufacturing jobs, those good middle-class jobs, start disappearing.
So globalization, with all these new players on the world stage, is driving this inequality in the richer countries.
Yeah, the competition pushes down wages and jobs move overseas.
So what are these leading economies supposed to do? How do they stay competitive and make sure everyone benefits from growth in this new global landscape?
That's the big question. Koo says they need to do major structural reforms in two main areas.
Okay.
First, they have to encourage innovation, like really reward it, make it easy for new ideas to flourish.
How do you do that?
He suggests things like tax cuts, deregulation, that kind of stuff, to make innovation more profitable for businesses.
Okay.
He also emphasizes a liberal education system that teaches people to think for themselves and apply that thinking to business.
So create an environment where new ideas can not only be born, but actually turn into real products and services and businesses.
Exactly. The second area is being more flexible and adaptable, and policymaking governments need to be able to react quickly to changing global conditions.
Right.
And Koo thinks the U.S. has generally been better at this than Japan or some EU countries.
Interesting. And what about fiscal policy? With all this low private sector borrowing, does the government need to step in more?
Definitely, Koo says in this stage, three governments need to be ready to borrow and invest in public projects, carefully chosen projects, of course.
So things like infrastructure.
Yeah, that kind of thing. The idea is to crowd in private investment, make the economic environment more attractive for businesses,
Makes sense.
and also directly fund cutting-edge innovation, support research and development, that kind of stuff.
He also talks about having some kind of independent expert commission to evaluate these public projects.
Right. Make sure they're actually going to benefit society and the economy in the long run, that the returns will be greater than the cost.
Yeah, that makes sense to avoid wasting money on projects that don't actually work.
Exactly. His point is that borrowing, whether it's a company or the government, is only a problem if the returns on that borrowing are lower than the cost of borrowing. If investments generate enough returns, then the debt is manageable.
Okay, that makes sense. So let's talk about global financial instability. Then how does this balance sheet recession idea tie into all the volatility and uncertainty we see in the markets?
Koo's argument is that when these asset bubbles burst, they leave behind a lot of debt.
Okay.
And so everyone, households, businesses, they shift their focus from making profits to paying down that debt. They're trying to repair their balance sheets. And that's when you get the balance sheet recession.
Right. And as we talked about earlier, lowering interest rates doesn't really help in that situation.
Exactly. It's like pushing on a string. And this can lead to what's called the QE trap.
Quantitative easing trap. What's that?
So central banks try to stimulate things by buying up assets, quantitative easing.
Right.
They might even push interest rates negative, trying to get people to borrow and invest. But even with all this cheap money, the economy just doesn't respond like they want it to. Inflation stays low, growth is weak. Japan and Europe have been stuck in this for a while.
It's like they're trying to water a plant that has no roots. You can pour all the water you want, but if it can't absorb it, it's not going to grow.
Exactly. They're trying to encourage borrowing and spending, but everyone's just focused on paying down debt.
So what's the solution?
Well, Koo even suggests that the strong U.S. dollar we've seen lately is partly because of this global QE trap. When the Fed hinted that they were going to raise rates,
Right.
it made the dollar more attractive because global investors were looking for higher returns.
So money flowed back to the U.S.
Exactly. And he talks about some unconventional policies, too, like helicopter money. Have you heard of that?
I have, yeah, basically just giving people money directly.
Yeah, there are a few variations. He talks about literally dropping cash from helicopters, but also things like the central bank directly financing government spending, or governments just giving cash to consumers. And even using government-issued script or these perpetual zero-coupon bonds, the basic idea is to get money directly into the hands of people and businesses so they'll spend it.
Interesting. So it sounds like the global economy is facing some really big interconnected
It
problems.
is.
And that leads us to globalization and how there seems to be this backlash against it in many parts of the world.
Yeah, Koo thinks the rise of these far-right political parties and all these protectionist policies is partly a reaction to globalization.
Hmm.
He even compares our current situation to the 1930s.
Oh, wow.
He says a bad response to a balance sheet recession can lead to some pretty dangerous outcomes. He's talking about the rise of the Nazis back then.
That's a scary thought.
It is, and he links this to things like Trump's election in the U.S., all that anger about free trade and the establishment.
Right.
Koo highlights Trump's argument that the World Trade Organization, the WTO,
Yeah.
it might have worked when the U.S. was dominant, but now that things are changing, it needs to be looked at again.
So he's saying the U.S. is not in the same position it used to be.
Exactly. And he reminds us about the basic rules of the global trading system, the most favored nation treatment and national treatment. These were the foundations of GATT and then later the WTO.
So basically, everyone gets treated equally in trade deals.
Yeah, no special favors for anyone.
Okay, but it seems like there's this tension between the idea of free capital flowing around the world and the reality of central banks trying to manage their own economies.
That's a good point. The idea behind free capital flows was that it would make the global economy more efficient,
Right.
but all this money moving around so quickly makes it harder for central banks to actually control things.
So what does Koo say needs to happen then? Does he think the whole system needs to change?
He definitely thinks we need to rethink things. When traditional economic policies don't work, the usual explanation is structural problems.
Right. Some countries just have issues that need to be fixed.
Yeah, but Koo says the real problem, and this is often overlooked, is these balance sheet recessions and the lack of good investment opportunities.
Ah, so it's not just about fixing individual countries, it's about the bigger picture.
Exactly. He emphasizes that we need tons of investment opportunities, both in physical things like factories and infrastructure, and in well-functioning financial markets. That's what drives a strong economy.
Okay.
He even gives the example of India. They've got these financial innovations like systematic investment plans and mutual funds that make it easier for people to invest. So
Interesting.
they're channeling savings into productive parts of the economy and helping it grow.
So the main takeaway from Koo is this idea of the other half of macroeconomics is focused on balance sheets and investment opportunities.
Exactly. And he's saying it's crucial for understanding why economies stagnate after bubbles pop.
Makes sense.
And his framework really gives you a new way to look at these big problems we're facing: globalization, equality, the limits of monetary policy. It's all connected.
It's pretty mind-blowing when you think about it.
It is, and it makes you wonder how this balance sheet recession idea applies to not just countries, but also to individuals and businesses.
Right.
Like, what happens if everyone you know is just focused on paying down debt and not taking any risks or investing in the future? That's a great question, and it brings Koo's ideas right into our everyday lives.
Yeah, it makes you think.
It does, and we encourage all of you listening to check out Koo's work for yourself and really dig into these ideas of balance sheet recessions and how to manage economies after these big bubbles. It's a really important perspective on the forces that are shaping the world today.
Definitely some food for thought.
Absolutely.